Ever wondered why bonds have been on a decline recently? It's quite the tale of economic twists and turns. A kaleidoscope of factors contributes to this trend, many of which revolve around the strategies of the Federal Reserve and the shifting landscape of economic data. Take the U.S. 10-year Treasury yields, for example. They've seen an uptick, reaching a peak of 4.16%. Meanwhile, their two-year counterparts are hot on their heels, nearing 4.5%. The ripple effects of these shifts have been felt far and wide. New York Community Bancorp, for instance, has taken proactive measures, implementing a preemptive dividend cut and rolling out liquidity strategies. Why, you ask? Well, it's their response to the uncertainty swirling around commercial real estate loans. As you can see, the bond market is currently in a state of flux, all due to a mix of economic data and Federal Reserve moves. Now, let's shift gears and talk about the strength of the U.S. service sector. It's been flexing its muscles recently, hitting a 4-month peak. This indicates not just economic strength but an upward nudge in pricing dynamics. This is a sign of a thriving economy, where services are in high demand and prices are on the rise. Meanwhile, over at the Federal Reserve, Chairman Jerome Powell has been dropping hints. He's suggesting that we shouldn't hold our breath for interest rate cuts in March. The Federal Reserve isn't one to make hasty decisions. They're taking a thoughtful, cautious approach to rate cuts, poring over incoming data with a fine-tooth comb. In essence, we have a robust service sector on one hand, and a Federal Reserve that's playing its cards close to its chest on the other. So, with the service sector showing strength and the Federal Reserve being cautious with rate cuts, we see a complex financial landscape. Now, turning our attention to the stock market, there are both opportunities and challenges. The service sector's signals, such as material costs and the Institute for Supply Management's gauge, are key to interpreting underlying trends and challenges in the stock market. For instance, the U.S. service sector is currently at a 4-month peak, signaling economic strength and an upward nudge in pricing dynamics. This could suggest a potential opportunity for investment in stocks, as a strong service sector often translates to better corporate profits. But it's not just the service sector that's in play here. The strength of the entire U.S. economy and vigilant monetary policies also offer both caution and opportunity for investors in stocks. The Federal Reserve, for instance, is taking a cautious approach to rate cuts, analyzing incoming data meticulously before making any decisions. This could mean a more stable and predictable investment environment, but it also means investors must stay alert to shifts in monetary policy. And speaking of shifts in monetary policy, Bill Gross, the renowned bond investor, anticipates a return to normalcy in the interest rate curve. This suggests that investors might need to strategize differently, perhaps by diversifying their portfolios or adjusting their asset allocations in response to these monetary policy evolutions. Lastly, there are seasonal trends, corporate developments, and economic indicators to consider. These factors present both opportunities and challenges for decision-making in the stock market. For example, New York Community Bancorp has implemented a preemptive dividend cut and liquidity strategies due to uncertainty in commercial real estate loans. This kind of corporate development can have a significant impact on stock prices and investor sentiment. So yes, the stock market is a complex beast, full of opportunities and challenges. But one thing is clear: despite the challenges, the resilience of the U.S. economy provides a stable backdrop for stocks and bonds, and that's something to keep in mind when you're making investment decisions. So what does all this mean for you as an investor? The decline in bonds, spurred by economic data and Federal Reserve strategies, has a tangible impact on stocks. However, the U.S. economy's fortitude offers a stable foundation for these investment avenues. The U.S. service sector's strength, coupled with a vigilant Federal Reserve, presents a blend of caution and opportunity. In conclusion, while bonds are currently in a state of decline, the resilience of the U.S. economy provides a stable backdrop for both stocks and bonds, offering both caution and opportunity for investors. But before we wrap up, we have something exciting for you. If you found this video insightful and want to stay ahead in the world of finance, consider subscribing to our YouTube channel. We regularly post content that helps you make sense of the complex financial landscape. Don't forget to hit the bell icon too. That way, you'll always be notified when we release new content. And if you think this video could help your friends or family navigate their financial journey, don't hesitate to share it with them. Thank you for watching. Don't forget to subscribe and hit the bell icon for more updates. Happy investing!